If you're part of this team has decided we are going to follow the SEC's regulation. We're going to be SEC compliant. And that's the team decision. If you're a team player, you help the team fulfill the decision. And that's why our firm grew so fast, is because everyone understood what team really meant. So when you raise money in a fund, it's never easy raising money. It's always a battle. So I like to tell people this because they misuse the word billion all the time. So let me give you an example. If I gave you $1 a second and I never slept, 1, 2, 3, 4, 5, 6, how long would it take me to give you $1 billion? Or how long is 1 billion seconds? The answer is it's 31.7 years of seconds. People misuse the word billion all the time. They'll say, John, I just went outside. There was this huge flock of birds. There must have been 1 billion of them. And I go, no, there wasn't. You know how I know? Because I did the math. You know when I did the math? When our company, me and my partners, we reached $1 billion AUM. It was like, how much really is $1 billion? And I got my calculator out. 31.7 years of seconds is $1 billion. When I retired, we were managing $28 billion assets under management. And then we went public on the New York Stock Exchange right as I retired. And then since then, we're now managing 47 billion-ish, right in there. And so the credibility of being on the New York Stock Exchange, my partners, after I retired, just took it to the max and was able to raise even more money. So the higher up on the ladder you get to institutions, the easier it is to raise big dollars. But it takes years and years and years to qualify to raise those big dollars from institutions. And like I told you before, institutions don't even write you a check, or they don't even come see you unless they can give you 30 million at a time. But in your first fund, I mean, if you got 30 million, you would just, from one investor, you'd just fall over and just couldn't believe yourself, right? So it's all a battle, one at a time, raising capital. Raising capital, and I can tell you from my early days when I raised capital, in the later days when I wasn't raising any capital or much capital, and my partners were raising capital and they were focused on it, they spent so much time, so much effort with institutions, family offices, high net worth individuals to raise every single dollar. Was a difficult deal. It never really got easy. It just got more in volume because you were playing on a different playing field, I guess you would say, when you're talking to institutions and you qualify for institutional type scrutiny. Yeah, so a high net worth person in real estate will bring their real estate person with them to come to your meeting and scrutinize how you evaluate real estate. And that's like one meeting, 2 hours. You talk to the potential investor and you're talking with their number one real estate guru. Institution, they will fly out 3 crews. One crew will come out of Chicago for 4 days. A week later, another crew will come out of Boston for 4 days. And another crew will come out of New York for 4 days. It's 3 weeks. And they're in your offices for 4 days. And so in a real estate, you'll have a crew come out and this institution will hire them and they will come out and they will go through every single real estate asset you've purchased in the last 10 years. They'll scrutinize everything. They'll get every data and they'll take them 4 days. Then another crew will fly out the next week and they'll do operational. They'll check all your bank accounts. They'll check who the signer is, who can sign, who has signed in the past. Have you ever had anyone hacked? Have you ever been hacked? That's 4 days. And the next one will come out, will do your accounting and your money and all your institution and your SEC compliance. So after 3 weeks, after you get them to come see you, then they go back and they make all those reports and they send it to their investment committee, the institutional investment committee, and they scrutinize it for weeks and weeks and weeks and weeks and weeks. And they call you back to clarify things. That's the difference of getting institution as opposed to getting a high net worth individual. It's miles apart. It's not even the same planet, right? If you're going out and purchasing funeral homes and you have fund 1 that's 400 million, fund 2 is 800 million, fund 3 is $1 billion, okay? And at some point, you and your team go, you know what? We believe that the retirement home business is the place to be. And we're going to start doing that. Your team would have to go out and recruit experts in retirement homes. And they would have to mesh culturally, work ethic-wise. You'd have to like them. And you'd have to believe that these are the people that could launch a retirement home fund, because you've been launching, your current team is experts in funeral homes. So you'd have to go into a new asset class and kind of start on fund one retirement, all right? And so that, but it's still kind of the same, it's the same type of thing. There are buildings, there are tenants, right? It's not too far distance, as opposed to saying, we've been buying retirement homes, fund one, fund two, fund three. Now we're going to launch a fund that buys and sells Bitcoin. That's a totally different, that's absolutely so far away from your skill set. So me and my partners, we just kind of stuck with real estate related industry because that was what our momentum was, and that's where we had skill sets in. If we would have ever found someone that was a total expert in trading cryptocurrencies, and they had gray hair for 15 years and they could show track record, we might have decided to do a cryptocurrency fund. But it's about the skill set. You have to go after great skill sets, and also has to be conducive to your overall theme. And our overall theme was kind of like this. We kind of do boring real estate. We just do, B, C class apartments. We do B office building. We just do B. We don't do like downtown Los Angeles. We don't do it. We don't do Manhattan, right? We do other cities that have properties. We do kind of the off-market, big market real estate, and that was our niche, and so we just kept rolling in that niche. That's why we stayed relatively in the real estate market. We did go back into lending on real estate from my first two funds, but my third fund we went into mainly apartments and office buildings, and then later we did some other types of real estate, and we then started funds that lent money on real estate, did loans. But again, it was all kind of around real estate. And then I think as I retired, right about the time we went public on the New York Stock Exchange, was you go public on the New York Stock Exchange not just because you want to go public. You go public because you need access to larger amounts of capital. So we had a vision to growing our company, and the higher up on the chain you go, the easier it is to raise large amounts of capital. And if you're on the New York Stock Exchange, which is the granddaddy of all stock exchanges around the world, once you get there, your credibility is much higher. You can raise capital easier because you had to go through more hoops, more hurdles, more scrutiny to get there and stay there. So as I told you before, when I retired, right about the time we went public on the New York Stock Exchange, we were managing about $28 billion assets under management. And then a few years later, we're managing $47 billion. After I was no longer in the company, I'm just a partner and just have shares and stuff. I wasn't part of the growth, but once you go on the New York Stock Exchange, it gives you a lot of credibility. And people who were going to invest with you, let's say $100 million before, they're now going to invest with you $400 million because you're on the New York Stock Exchange, and therefore they know the people who are on the New York Stock Exchange have to go through more SEC stuff, more scrutiny, more everything. There's more controls on a New York Stock Exchange company than some guy that just started his first fund in Atlanta, Georgia, and he's going to start doing $500,000 loans. There's more scrutiny on that. Therefore, it's kind of on the risk parameter. You've mitigated risk for the investor. And that's why there's more money that flows. That's one of the reasons, I should say, more money flows in once you go public. Yeah, so think about this. If I start a fund and I'm going to buy apartments and I deploy $350 million, and that fund has an 8-year life, okay? And I do that in 2 years. I deploy $350 million, right? Now I'm managing AUM, $350 million. And as soon as that fund is 90% deployed, I start fund 2 buying apartments. And I raise $600 million, okay? And that allows me to buy $1 billion. So now I'm managing $1.3 billion. And that fund's got an 8-year life. And that's in year 2. Your fund 1's still running. Fund 2's still running. I start a third fund, After Fund 2 has been 90% deployed, and I raise $1 billion, that allows me to go buy $3 billion worth of property. So in 2 or 3 years, I buy $3 billion of property. So in 7 years, Fund 3 is managing $3 billion, Fund 2 is managing $1 billion, and Fund 1 is managing $300 million. So I've got, that's my AUM. And so then when you branch off and you do another asset class, like don't just buy property, let's have another fund that lends on property, then you have a lending fund that's Fund 1. If you had 3 funds that had purchased funeral homes, funeral home number 1, $300 million, funeral 2, $1 billion, third fund, $3 billion, and then you branched off and started buying dental offices. And the first fund had $300 million. So over those, you have this, and over 8 years, you accumulate these huge numbers of AUM under management, assets under management. That's how it's done. You still are expert in your asset class, funeral homes. There's still a great number of funeral homes to purchase, fix up, get them running right, economy of scale, get their profit margins up. They're still out there. And so you still go back to your investors and you still say, listen, we just spent all the money in Fund 3. We're now out of money, but there's still a great market opportunity. Are you guys still with us? And they say, yeah. So their investors put more money into Fund 4. And that's how you accumulate over time the AUM, how the AUM grows. So there's a thing called Form PF. And once you hit $1 billion, and I'm going to mess this up, if a liquidity fund hits $1 billion, they have to file Form PF. Part 2 and Part 3, I believe. If a hedge fund hits $1.5 billion, they have to file Form PF Section 2. And if a real estate fund hits $2 billion AUM, they have to file Form PF more sections, okay? And so Form PF is a form you have to file with the SEC, and it's pretty easy when you're 100 million, 2 million. It's not too bad. But once you get into the Part 2s, these forms take 3 or 4 weeks to fill out. You don't walk into the office one day and Monday morning and say, I'm going to fill the Form PF out at the SEC, and at 5 p.m. it's done. No, these are complicated, extremely detailed forms that the SEC wants to know about you, your investors, your employees, who gets paid, when they get paid, how they get paid. They want to know a lot of things about you. And so you really can't do Form PF until the end of the year, until the first quarter usually, or the first quarter of your fiscal year, because you have to have the data from your accounting department. And your accounting department's putting all that data to January, February, March, and you're sometimes waiting until like March 31st. You're waiting to the last day to get certain data in so you can complete, because you try to submit your PF, Form PF, and it's not complete, they just reject it. And they'll tell you, you're missing item on page number 73, section 5, paragraph 2, and you're missing item on page 142, section A1. You're missing that item. And you have to have this thing completed and submitted on time to have Form PF. So there is a lot more scrutiny as you get larger. The SEC came into existence in 1933, and they came into existence because of the great stock market crash of 1929. The first person to run the SEC was Joseph Kennedy. He was John F. Kennedy's dad. And the reason I think they chose Joseph Kennedy is because, well, he made a lot of money in the stock market crash in 1929. And it's kind of like hiring the fox to tell you how to make your hen house fox-proof, right? So they hired Joseph Kennedy to help that there would never be a huge stock market crash again in the future. And so that's why that came into existence. But again, the SEC on the private fund side, private equity fund, they're trying to protect the small investor, the non-accredited investor, and sometimes the accredited investor. They have rules that limit the non-accredited investors on what they can invest in. And so as we're structuring our funds, we had to put funds together that allow for accredited, qualified client, qualified purchaser. We had to structure our funds to allow certain investors to come into those funds, because the SEC is trying to, for instance, if there's a postman that delivers your mail and he makes $40,000 a year, the SEC is trying to protect that person because that person can't afford an accountant, a fund manager, or an investment advisor, and a lawyer to scrutinize the details and the risk of a very complicated PPM and LPA. But a qualified purchaser who has $5 million of investments, they can afford a lawyer, an investment advisor, to scrutinize the intricacies of a PPM and an LPA. And therefore, if the qualified purchaser loses money in this fund, the SEC doesn't care unless there was fraud. But the SEC wants to protect the smaller investor. But if you think about it, so the smaller investor can't get into these really, really great funds that make a lot of money, but they're the ones that need it the most. So that's the trade-off there from the SEC trying to balance. We don't want thousands of people that are non-sophisticated investors that they can read this PPM but don't understand half of it. And we have complaints in a few years from now from all these people that lost their money. And if the rich person who has $5 million in investments loses their money in a fund and the fund didn't commit fraud, they just didn't work right, SEC doesn't care. That's one of the reasons SEC came around. The other reason on the top end is the larger amounts of money that you accumulate and you are managed, SEC throws more and more scrutiny on you so that you have to work to qualify to run $2 billion, $3 billion, $4 billion funds. And that's why Form PF is there, so they can really scrutinize if you're running a good fund or not. No, those three circles you just build out. You build out hundreds of employees in this circle, hundreds of employees in this circle, hundreds of employees in this circle. What you need is training. You have to send your people to regulatory training. They have to have on-the-job training. You have to send them to conferences. You have to send them to stay up on all regulations, all new tax regulations, all new IRS stuff, all new SEC stuff, all new fundraising regulations, what you can and can't do. And the regulations change. The Dodd-Frank Act after 2008, 2009 came out, changed a lot of things in the regulatory market, and we had to train our staff and our partners on what the new things were. And we have to comply with those things, and sometimes they are painful to, a lot of regulation is painful to do, but some is just very painful, and you have to do it if you're a team. And that's what we kept pushing is, if you're part of this team has decided we are going to follow the SEC's regulation. And the SEC regulation says this. And we would say to our employees, are you a team player? Or do you just say you're a team player? Are you going to get your monthly or quarterly financials in on time? Or are you going to have the compliance officer have to call you every quarter and say, where's your financials? So are you part of a team, or you just claim to be a team player? Because the team has decided we're going to be SEC compliant. And that's the team decision. If you're a team player, you help the team fulfill the decision. If you're a person around the water cooler complaining and not getting in your reports on time, then you're not a team player. You got a couple choices. You got to get off the team, or you got to become a team player and row the boat in the same direction, even though you don't like it. That's part of building a team that functions, and that's part of teaching your staff, your partners, yourself too, that if I'm a team player, I have to do things that I don't necessarily agree with or want to do, but if the team decided that's the right thing to do, and I had a chance in the boardroom to argue why we shouldn't do it. But once the argument is over in the boardroom and you leave the boardroom, there's no going back to your office and bad talking with your other employees about this decision. There's no around the water cooler saying, well, I'm not going to do that. No, when you leave that boardroom and the team decided, even though it was a big argument, the team decided to do something, when you leave, you have to be the best team member ever and row as hard as you can that rowboat with the same team. And that's defined as a team. And if you're doing anything less, you only say you're a team member, you're not really a team member. And that's the type of culture my partners from the top, from the chairman of the board all the way down, built our firm. And that's why our firm grew so fast, is because everyone understood what team really meant. I use this analogy. My sons teased me. They said, Dad, how are you like a co-founder of this huge, huge real estate fund, and you really don't know real estate that well? I kind of laugh because they're right. I mean, I'm not a real estate expert. I'm a fund expert. And I give them an analogy of this. Okay, let's just say I play baseball and I want a World Series championship ring on my finger. And I know if I go out for teams, I'm probably not going to make it. I'm a good baseball player, but I'm just not going to stand out there going to say, we're going to draft you. Okay, but I still want to be and have a World Series ring. So I know how to build and get money to build a huge baseball stadium. I know how to get contracts. I know how to get the best hot dogs. I know how to get the right seating and the right architects. I know how to get the best television contracts that give us the most revenue, and maybe with the best television coverage, I can attract good baseball players. I'm a good pitcher, but I'm nowhere near good enough pitcher to keep winning on a constant level. I need a pitcher that can throw a 98-mile-an-hour fastball. I can't throw a 98-mile-an-hour fastball. So I build the stadium, I get some people together, we get more partners, build a stadium, and finally, we have the best television contracts. Because we have the best television contracts, I can get a guy who can throw a 98-mile-an-hour fastball for less salary, but he's going to get national, a lot of TV coverage, and I'm going to do something that other firms won't do. I'm going to give or allow that person not only be the pitcher, and this, because he's a great pitcher, have equity in the baseball franchise. And then I'm going to not be pitching anymore. I'm going to go to center field. And then I'm going to attract someone who can run a 4.2 40-yard dash center fielder, because I can't run a 4.2 40-yard dash. And then I'm going to get that, and then I'm going to go to second base. And now I'm playing second base. And now I have surrounded this team, and they all are aligned, because when jerseys sell in the gift shop, every team member gets a little piece of that. When hot dogs are good sales, they own part of the team. That's how I became and got a World Series championship ring. Not because I'm the best baseball player, because I could do certain skills other people couldn't do. I know how to start funds. I know how to start businesses. Some people go to college. They work on Wall Street for years and years and years. They never start their own business. They can never make the jump. And I want them to make the jump. And they make the jump, and they can do it better than me. And that's my plan was from when I was 40, and I thought that's the only way I can really build a big company and attract great talent. I have to build something that they want. And most of my partners wanted to be part of a private equity fund and be an owner rather than an employee of where they were before. They were making great money where they were before, but they wanted to be an owner. And so my baseball analogy helps people understand why I am one of the co-founders of a very large real estate family of funds. I always knew from the beginning, this is what happened in 1999. And look, I didn't start my first fund until I was 40 years old. 2004, I turned 40. I ran my life out in a chessboard, kind of. There was only so many moves I could make, all right? And I had already had 13 businesses before. And I said to myself, listen, I want to try one time in my life to do a really big company. But I know I don't have the skill set to run a really big company. I have to bring in other talent. So that was the first humbling thing I had to take, that I was going to continually try to find people that do things better than I do. That was the first thing, because I wanted to run. Now, I said to myself, listen, John, you know a really big idea. Small companies that go bad, it's a year and a half, and you give up and you just shut the company down. But big companies take about 6 years to know if they're good or not. I mean, Amazon.com lost money, I think, for the first 10 or 12 years. In the 9th year, they didn't know if Amazon was going to make it, because they were losing money every single year. It takes years and years and years to know if a company's not a big idea, a huge idea, is going to work or not. And I wanted to try one time a really big idea. And so I said to myself, John, you're going to go try a big idea at 40, because it'll take you 6 years to know whether to quit and just turn it in and go back and do something else. John, if you wait until you're 50 to light that candle, to light that firecracker, you won't know if it's bad until you're 57. And then if you have to go start another company, you're not going to be able to retire. You're not going to have time to retire to 70, okay? But if you start at 40 and it goes bad at 46 or 47, you have plenty of time to start something else and retire at 70. So I was like, John, you have to try one big idea in your life. Yes, because I don't want to regret when I'm 70 years old I never tried. Second, okay, you can't go at 50 because you're too much of a conservative dude. If you wait till 50, you won't do it because you won't risk retirement. So therefore, the only option is to go big at 40. So I had to go big. And to go big, I had to find more talent, leaders that were better leaders than me in certain areas, and I had to find people who were smarter, driven, hardworking, just like me, but they were smart and smarter in different segments of the company that I needed and I wanted to be a part of. I, for better or worse, knew how to find the best hot dogs and the best jerseys and build, kind of thing. But I'm not the best baseball player. But my team wins the World Series every single year. And I get multiple rings, and I'm on the bench sometimes, and I'm playing second base, and I'm on the bench sometimes. I'm a good baseball player, but that's the analogy. For my success, I needed to take a reality pill, swallow a reality pill, and an ego pill. Swallow the ego pill. I had to do both. But just reality, I mapped it out. A big company, what it takes to run a big company. And I was good at this, but I wasn't great. To run a great big company, I need great. How can I get great? What skill set do I have? I can start companies. I've started a bunch in my life. I can get them up and running. I can get them going. And the best thing I could find was the general partnership, limited partnership structure, and then just give up pieces of the general partnership and the company and attract and align these incredible partners that I got, align their interests all together, and we all did the same thing, and we aligned everyone's interest, and aligning that interest, it caused just a great team that could win the World Series every single year and get those World Series championship rings. Not a little bit. These people that came in, they got big chunks. It was to attract them to come. Not me, our firm, our partners, our current partners had to give big chunks to people, not little bits. It was because, me owning this 100% or me owning this of this thing, it's just owning a piece of a bigger pie, I guess, a smaller slice of a bigger pie was my goal. Because when I told you when I was 40, I wanted to be a part and a co-founder of a really, really big company. I wanted to do something large. And so therefore, we, my partners, gave up and attracted talent, people that could throw a 100-mile-an-hour fastball with giving them big slices of equity. I think when I retired, I had 32 partners. When I started my first fund, it was just me and another guy. I was 50-50, right? And then 16, 17 years later, as I retired, it was, I think it was, something like that, 16, 17 years from starting my first fund to retiring at 57 years old, 17 years, right? I think in the end, with all the funds that we had, I count about 32 people as partners or owning enough of the company to have a partnership status, and that was it. Well, it was mainly salary, bonuses, and a piece of the equity, right? Or a piece of the carried interest, which is determined by the profitability of each fund. So when you're managing, a lot of funds and they're managing billions and billions of dollars, funds come to fruition and they start selling off assets, and that's when the big profits come. And you share in that 2 and 20. That 20 is where you share. That's where most of the money, that's where I believe most funds should focus on the profitability of the managers. If the manager of a fund is making a lot of their money off the 2% management fee, that's not a fund I don't think you want to invest in. I think you want them aligned with you so that when the fund makes really good returns, they make really good returns. The 2% management fee should just cover the salaries and the expenses of the people watching and running the money. When they do very well, the funds do very well, that's when the big compensation comes. If the funds don't do good, then they shouldn't be compensated. So that the main part of the compensation for fund managers should be the 20% of the profits, not the management fee. Yeah. That third fund, we moved to the 220 because these were going to be longer term. In the lending, we were only lending 1 to 6 months on loans. So we had loans that were turning over every 3 to 6 months, and we could realize the profit, quantitate the profit, divide the profit, because the loan was done. But when you're buying a large apartment complex, you're going to hold it for 5, 6, 7 years. During that 5, 6, 7 years, the people running the place need to have some salary, so that's why we switched to the 2 and 20, which is the standard fund these days in America. Yeah, so in a general fund, our funds were more value add fund. So in some real estate funds, you're just going to buy a brand new property and hope the market goes up and collect rents. We decided, listen, we are going to buy properties that we can value add. Before we buy the property, can we change the capital stack? Can we get better loans because we're large? Like we buy it from a mom and pop. Mom and pop has a high interest rate, and just the fact that we're large and we can push our banks around, we can get a better interest rate. We don't have to change the property at all. Just buy the property and change the loan mechanism, the capital stack, and we were already profitable. So that's a value add. We added value to the property. Or we can go in, if we refurbed 50% of the properties, the kitchens, then maybe we could charge a little more rent, and that would make the property a little more valuable. So ours was value add. We were looking for properties that we could value. If we couldn't buy the property and add value, we didn't buy it. Because we believed if the market goes up or down, that was ancillary to our business model. Our business model was we can get great returns for our investors by something that has some problems, and before we buy it, we know how to fix the problems. Once we fix the problems, then we'll sell the property and we'll gain that value added to the property. It's as simple as this. I could buy and sell gold in a gold fund, but wait, if I buy gold and I wait for gold to go up in price, that's just a gold fund. But if I can buy the bar of gold and then take that bar of gold, let's say I pay $1,000 or $2,000 for this bar of gold, and then I turn that bar of gold into this incredible, beautiful piece of jewelry, I put workmanship into it, I value add it, I would sell that same amount of gold for $3,000, right? I value added the asset. I did something to the asset to make it more valuable, and I sold it for $3,000, and me and my investors share in that $1,000 profit. But if I buy the gold and wait for it to go up in price, I'm just speculating. I'm not value adding. So if I buy a brand new property that just got built, I can't do anything to it. I can rent it up, get it rented up, and just wait for the market to go up and collect rents, right? That's the same thing as a bar of gold. So we didn't do that. Our stick was, our business model was, buy something that we know how to add value to and then sell it.